And good morning once again. Welcome to our live show. I'm Cheryl Miller. If you have a 401k or an IRA, good news if you're trying to save more money. The Internal Revenue Service has just increased contribution limits for both of these types of retirement accounts. Local money expert Bryan is here with an explanation of how this can ultimately help your bottom line. Hi, JB.
Especially people like you, Cheryl, that maximize every year. We know that.
Oh, sure. But if you can, maximizing your contribution is definitely the way to go.
Definitely it is. And one thing I want to add in today's discussion, that you can maximize your contributions to the 401k at work or whatever your work retirement plan is and still contribute to an individual retirement account.
So I did not know you could do both.
Right? And a lot of people don't. So when I think of something that I think people at home are overlooking, but there are income limitations. So they do need to make sure that they check that out and investigate it. But definitely you can have both.
So this is the first year in a few years that the contribution limits have been adapted, right?
And they've been good about increasing the 401k, the work plans, I should say, the work plan contribution limits. But the IRA hasn't seen an increase since 2013.
Yeah, so 6 years-ish.
And it's a nice bump. It's almost 10%. Now your maximum IRA contribution is $6,000 versus $5,500 last year. So that's a blessing.
Now, we can make a contribution to an IRA through April 15th. So can we still maximize at that new limit for our taxes for 2018, or is this going forward?
Someone might try that, right? But no, you have to, even if you're making the contribution for 2018, when you're making it in this year, you have to go by last year's guidelines. And actually, if the person is doing an extension, they have until October to make that contribution for last year. But you have to make sure that when you tell the financial institution that this contribution is for last year.
So you have to make sure you designate all these things.
Yes.
All right, this is different than the makeup contributions, because if you're of a certain age, you can always put more into the account.
I love it that you call it makeup. They call it catch up, but I know exactly what you mean. Exactly. Yeah, so you want to make up time.
Yeah.
Right? You want to so you definitely, it's for people 50 and over. They can actually, their limit, the amount that you can put in has not increased, but it's still $6,000 for people, additional $6,000 that you can save in your work plan when you're 50 and over, and into your individual retirement accounts and the Roth accounts that you can do $1,000 additional dollars when you're 50 and over. So that's a nice little bump.
So with the exception of the Roth accounts, because those go in post-tax, this IRAs and 401ks are a way to save on your tax liability for now.
I love it. That's right. It reduces your taxable income. So it can allow you to qualify for some things that you may not have qualified at your original higher income. So it does but it does, when you take the money out, it will be all taxable income at that time. So the Roth, if you follow the guidelines, could eventually be completely tax-free on the withdrawals, even though you didn't get the deduction on the contribution.
So the idea is put it in now when you're hopefully at a higher tax rate, and then when you start taking it out, you should be hopefully retired and at a lower tax rate.
Well, not hopefully, right? But more generally that does happen. Or you may think that politically we're going to be in an environment down the road that is a lower tax bracket, that taxation will be lower. It is possible. If you think that it is highly probable, then you'll love contributing to the Roth, because you'll say that I don't need the deduction now. I'm going to need it. I'm going to benefit more from it later, or I'm going to take advantage of it now because the taxes are higher. So if you think the taxes are higher now than they'll be later, you better contribute as much as you can now. And if it's flip-flop, you'll follow the first suggestion. You know, make sure that you, and a lot of people are now moving towards saying, I'll forfeit the current deduction because I do feel that taxes will be higher later. But and one thing you may know for sure is that if you're going to get a big inheritance and you're going to have a lot of income already for you down the road, then you could benefit from using the Roth so that you don't have that additional taxable income. So that inheritance is something you would know for sure versus trying to determine the upcoming tax brackets.
You think you know for sure that
Right.
somebody's going to leave you some money, or there's going to be some money down the road.
Or you know for sure that you're not. Yeah,
Right.
so indeed. So save as much as you can for yourself.
Right. And the 2018 tax year that we're going to be filing for hopefully shortly
Yes.
is going to be interesting because of the change in the tax rates. The flat tax deduction has gone up for both single filers and married filers. And so we might have to do our taxes both ways, itemized and standard deductions, so that we see where we stand.
Well, because the standard deduction has doubled.
Right.
So you may not even need to itemize this year. So you could actually save money in doing your return if you're paying someone, because you really might not need that Schedule A. So to do the itemization. So we have to be conscious of that. And a good way to determine that is to look at last year. You know, did you take the standard deduction last year and nothing really changed? Then definitely with the standard deduction doubling, you don't have to worry about itemizing at all.
Right, or kind of look at your itemized deductions if you had itemized and see if you're going to beat the threshold for this year.
Yeah.
So you got to be self-educated.
Oh my goodness, yes. And you don't have to worry about all of that when you do your contributions to your retirement account. You get them regardless of itemization. You know, it's not
That's a
like,
good thing.
yeah, it's not like the charities and if you can write off your mortgage interest and things like that. This is a guaranteed reduction in your income if you participate in these plans, in the IRA or the work plan, or possibly even both.
So if you can afford it, then you should maximize the accounts.
Maximize the accounts, and some people do the additional IRAs because they want to be able to invest in things that aren't available at work.
Right.
So definitely continue to get educated. The Virginia This Morning show is great. This
When
discussion,
you come to see us. Well, thank you,
this
JB.
discussion is great.
All right. And JB offers free weekly money seminars and webinars. We'll put a link to more information on our website. Just go to WTVR.com/VTM.